what if when you saw one of them was down, you bought it, when it went up 10%, you sold it. And then you found something else, did the same thing. Oh, and lo and behold, this one's down again. So you buy it back and you do it again. Things like Pepsi and Esso, Exxon, all the oil companies, healthcare companies, everything has this cyclical and fundamentally volatile nature over time. And we just started trading and trading and trading. So when I first got my hands on an investment portfolio, and fortunately, my situation was such that I did get that into my hands when I was about 25. Literally had a pile of stock certificates dumped on my desk. And you're probably too young to even ever seen a stock certificate.
Yeah. No, I'm all.
They used to be pieces of paper, and it was just like the title to a car.
Yeah,
you could
right.
turn it over, sign it, and give it to somebody else. They could pay.
Those days are gone, my friend. Yes.
Those days are definitely gone. But anyway, I started investing, and interestingly, all the stocks I owned were dividend payers. And then I started looking with my broker. I started looking at charts, and I looked at how they fluctuated in price over time. And think of this as the Dow 40 stocks. That quality of company. And over time, they all go up and down, all go up and down, all go up and down. So what if when you saw one of them was down, you bought it, and when it went up 10%, you sold it. And then you found something else, did the same thing. Oh, and lo and behold, this one's down again from where it was, where its high was. So you buy it back and you do it again.
Yeah.
And things like Pepsi and Esso, Exxon, all the oil companies, healthcare companies, everything has this cyclical and fundamentally volatile nature over time. And we just started trading and trading and trading.
Yeah.
While the dividends kept rolling in as well. So within 9 years, 1979, I was making about five times what I was making going to work in New York.
There's nothing like a nice refinance or sale of a property too to get that huge six-figure payout. That's a beautiful thing also, but it takes time to get there, right? You're not really, it can take 5 years, 4 or 5 years to get to, a refinance of a property or a sale of a property. And well, once you sell it, you have to pay capital gains tax, and then you lose that cash flow machine. So I like to hold on to my real estate, but cash flow is a beautiful thing. Absolutely. And, so let's break a little bit more into the types of assets you actually invest in to create this consistent income stream. So what is a closed-ended fund? Maybe we could start there.
You're familiar with ETFs, of course, which is a fund, and mutual funds. Yep. Closed-end funds originated more than 100 years before ETFs, and a few years, 20 or so, before mutual funds in Europe back in the early 1800s. The primary difference, all of them hold a group of securities of a certain type, or maybe of a variety. They hold these securities, and they are passively managed, or managed most of the time, or in CEFs, managed all the time completely. But CEFs are pass-through trusts, which I'm sure you're familiar with. They have to pay to their shareholders 95% of the income they receive.
Okay.
So let's say they hold a portfolio of tax-free municipal bonds, and they have $100 million worth of bonds, and they're all yielding 4%. All that money is going, 95% of it is going to the shareholders. They're not using it to build their enterprise. They're not buying more buildings. They're not buying more of this. All they're doing is investing. And they're going to be the ones that buy the bonds at a discount and sell them when they go to a premium. They're not going to be the ones that just hold on to them and clip the coupons. So you've got that going on. Not only that, just as we do in real estate, nobody goes out, or at least not too many people go out and pay cash for that apartment building. They borrow the money.
Oh, sure, leverage.
And they buy something, and they know that they're going to be able to generate more income than the payments.
Yeah.
That's why they do it.
Sure.
The same thing with these trusts. They can borrow money without it being a margin loan or anything like that. Borrow money, and instead of buying another building, they buy more securities.
Mm.
So for every dollar of actual investment from shareholders, they have another pool of capital that's in the fund that produces income.
Okay.
So instead of municipal bonds right now yielding 4%, a closed-end fund of the same municipal bonds is paying 6.5%. And instead of waiting for a semi-annual payment, you're getting a monthly payment.
Okay.
Boom, boom, boom. The same principle carries over to those that invest in preferred stocks, in mortgages, in income real estate, and in the stock market.
Yeah. Yeah.
So this is the type of vehicle I use. The average yield in tax-free is about 6.5% today. The average yield in taxable closed-end funds is about a little over 10%, and the average yield on equities, you're not going to believe it, is just under 10% in today's market. So you could own Tesla, you could own Nvidia, you could own Microsoft, and instead of it yielding you 0%, in the closed-end fund vehicle, it's yielding you almost 10%.
In cash flow distribution, and then you also have the equity gain on top of that.
If the market goes up, you can take advantage of that equity gain and produce income stream number 2.
Right.
Capital gains.
Right. Exit stock over time. Yeah. Cash in your equity.
Not even over time. You actually take it. You take it on the closed-end fund as the owner. And then you just buy that closed-end fund, do it again. And if it doesn't go up, fine. You're still getting 9% yield. If it does go up, you've got the dividends you've received, and then you take the profit, and then you do it again.